what the heck's going on with mortgage rates? Fed just lowered rates a quarter point last week. Election results are in, and mortgage rates just kind of seem to keep climbing. Hey, Colorado, Chris Lopez here with your monthly market update for October 2024. So we are going to cover market stats for Denver and Colorado Springs. And we're also going to talk about some rental data and rental trends that we're seeing as well. We're going to touch on some vacancy numbers in Colorado Springs, and then talk about some deals, and also talk about some potential downstream effects from the election outcome. So I've got some of the usual crew with me and some new faces. So I got Jeff White with Envision Advisors. What's up, Jeff?
Not much, just living the dream out here in beautiful Denver.
Well, glad to have you back. I got Troy House, Nova Home Loans. Good afternoon, Troy.
Hey, Chris. Good to see you.
Great to have you back on the show. And then have Jenny Bayless is usually representing Colorado Springs. She is traveling this week, so she's not on the show. She'll be back next month. But we do have a new co-host for the month, Brandon Schulten with Keyrenter. So we've done a couple, I think 1 or 2 webinars and podcasts with Brandon and the team, and we've gotten great feedback from the insights and Brandon's ability to communicate these topics. And as we were talking about, hey, bringing more data and more things, having a property manager's perspective on the trends, and they manage about 1,100 units around Denver here, has some amazing insight. Plus, he runs a great PM business. So, Brandon, welcome to the show.
Thank you. Yeah, I'm excited to be here and excited for this discussion.
Yeah, we're going to grill you with some rental data questions. So be prepared. Now I'm excited to have you on the show here to just have a different perspective. All right, so let's start with market stats here. So the one that I want to really focus on is just prices. So I got some high level prices here from Colorado Springs with PPAR. So home prices are up about 4% from last month, and flat at 0% over the year. So about 0% year over year and 4% from last month. Now condos are down 8% last month and down about 5% year over year in terms of that category. With the Denver, what we saw here, and I want to pull up this chart because last month, Jeff, do you remember what happened to prices last month?
Didn't they go down a little bit?
Yeah, they went down like 3 or 4%. And so that was obviously a surprise. And I shared some commentary that it was predicted for prices to come back up. Well, that is what happened once I find the spreadsheet here. So if you guys can see this, average prices, and we got closed price and average year over year, 3.7% for average and 3.3% for median. So if we actually go down the graph here, this does a better job of telling the story. You can see in October 24, we were at 708,000 for attached homes. Last month at 672. So if you look back at the graph, that 672 was a big drop, especially compared to past seasonality. So that looks like that was just an outlier, and due to just the fact that we sold a lot less expensive homes and more homes in that $400,000 to $600,000 price range. So does that surprise anyone, or any commentary on that?
Pretty much what I expect for the uncertainty of the mortgage market, plus the uncertainty of right before the election and post-election. People usually don't make big decisions like buying houses, or people that do, then you just don't have the same variance. Like with rates being higher, you're just not going to see as much transactions, because the only people buying right now are people kind of like have to buy because they're like moving here, or like a move up buyer. But it's just going to be kind of flattish until rates come down. So Troy, could you help us there, please? And
I will do what I can. I'll put in a good word.
Yeah, I'm not surprised that it's been kind of flattish, and I kind of expect that going forward until rates come down about 1.5%.
All right.
Do you think there's anything to that? It did trend up that last month or whatever, and that didn't seem to match what it was doing leading into that.
What'd you say, Brandon? For
Just I
this
see
part right
that
here?
the last month, all of a sudden a trend up. Is there any way to make sense of that?
Yeah, well, we think more like this one right here, the 672 for September, where my mouse is. That I think that's more the outlier data, where we saw like a big drop in there in September data. It was like down 4% year over year. Like the year before is sitting about 682. And so the reason that happened was, I think the best thing that I've seen is Denver sold a lot less expensive homes, like 700,000 plus, or a lot less, I don't know, 5 or 10% less, and then sold more homes in that 4 to 600,000. So just the actual like unit stuff on there is what changed the appreciation. I think this month is back to more normal unit mix, which is why we're seeing prices go up. So I think we'll see a sharp go up in here. I don't think it'll continue that high. I think it'll flatten out. But I think it'll stay here and be a very gradual slope up is my prediction. But talking about growth on here, Brandon, can you share what you're seeing in like year over year and month over month rent growth and where rent's at for industry stuff, your portfolio, any data you can share?
Yeah, absolutely. So, since I wasn't on the last couple months or whatever, I'll share kind of, we typically we see this fall off in demand and prices kind of right around when kids go back to school. Not as many people want to move then, but the inventory is often still up. So you have this sudden shock right there around end of August, early September. And we saw that as usual, but we were already coming out of a slower summer than what we've seen the last few years. So it's just been overall slower, still having the same seasonal trends. And then like September was extremely slow. A big drop there. October and the first week or so of November have been still slower than what we'd expect, but kind of a usual seasonal trend of tapering off. But yeah, as far as the data I look at, one of the biggest things I saw is year over year we're seeing prices across all amount of bedrooms and that kind of thing in Denver down about 7.5% year over year. So pretty significant, and we feel that in our own portfolio of homes that
What was that number again?
7.5%.
It's up 7.5%.
No, it's down.
Down. Okay, that's what I thought you said. So this is portfolio wide.
Yeah, absolutely.
Wow.
And we see it certainly some places more than others, some types of homes, that kind of thing. But yeah, we have homes that we rented a year ago and we're at $200 less on the market or something and struggling to get interest, kind of thing. So yeah, we very much see that.
And is that across homes and condos and just across everything? Or is there like one unit type that's really driving? Or is it just everything is?
I was digging into the data and a couple of things popped out at me. So one thing is like the 2-bed, 1-bath condos or 2 1.5 are worse than they've ever been. Like that is really, really hard to rent right now. All I could think is like maybe people have gotten more and more resistant to sharing bathrooms or something. But also like 3-bed, 1-bath houses are brutal as well. Like, yeah, just softer than ever on those kind of 1.5 bathroom type places.
So it sounds like overall down about 7.5%. And then kind of the least desirable type of properties in the portfolio, the single bedroom tough, they're just probably seeing the most softness in terms like just the renewal and rent growth.
Yeah, like the 1 bedrooms do okay, but yeah, specifically like the 2 beds are some of the hardest ones, like the condo.
Okay.
And some of that I think relates to just what's come online with the inventory in the new construction, because we keep getting waves of A-class apartments hitting the market. So that's nothing new, but it's always been hard with condos to compete with that. And yeah, we're just seeing that more pronounced than ever.
So talk about that. So with all the Class A coming stuff online, what type of ripple effects is it having through like smaller landlords and the Class B, Class C, and just non-Class A apartment rents?
Yeah, I think part of it's just seeing the drop across the board. I would say like one of the challenges we see with the small landlords is these big apartments that are coming online really are chasing this pro forma, and they're just like motivated to hit hit a point where they can, often they're selling the property or whatever. So they will give really good concessions or incentives to get people in. So they're giving a month or 2 months away and a free TV and all this kind of thing. So they'll do that to get their premium rent, right? So that then they can show this pro forma. But for a small landlord, that can be really hard you already had vacancy costs, and now, it's hard to compete with those kind of incentives. And so oftentimes you're better off competing with just a lower price. And but yeah, that certainly has an effect in driving down prices on the condos that compete most directly with A-class apartments. So yeah, and then single family seems to be a little bit better insulated from that effect from the A-class stuff. But again, we're still feeling it there, seeing prices down. I checked the same data for Colorado Springs, same data source, and it's showing flat year over year. So no change on their rental market. So they've performed better than Denver has.
Okay, so they're flat, and Denver's about. So I'm sorry, this data, is this from your portfolio or just like general Denver data?
Yeah, we don't manage
Or a little bit of both.
Colorado Springs. So no,
Yeah.
what I was sharing there is from like Zillow. They do a
Okay.
market overview.
Yeah, Brandon, would you say a lot of the stuff that's managed by your company that competes with A-class, or would you say most of it's in B and C stuff?
Yeah, it'd be mostly like the B stuff. C-class in some ways I don't think is as impacted because there's a little bit of trickle down, but like just the difference between what they're building and putting on the market versus your $1,300, $1,200 one bedroom apartment. It's just a very different tenant and location and amenities and all that. So yeah, those seem to be somewhat stable.
What about, and you mentioned seasonality. So, and you said seasonality is pretty much the same. You're seeing that stay consistent?
Same trends, yeah, where it's like you see this drop off right around late August, early September, where it really gets hard to rent anything. It's not like prices come back from that in October, November, but it feels like there's just things kind of stabilize. And so, yeah, we've been renting a decent amount of properties the last probably 45 days, something like that. But yeah, still seeing more than we have in past years get to 30, 45 plus days on market, where we really have to get aggressive with price drops together.
Along those lines, what are the strategies that you guys do to fill vacancies if the lease comes up in September, October, November?
Yeah, I mean, you got to get creative. I think several things. One is just like invest in soap and water. Nothing, there's nothing cheaper than just making sure the place smells fresh, feels clean. Also, sometimes we'll waive application fees just to encourage people to apply. Offer small incentives or, a couple weeks free or some little move-in promo. Yeah, things like that. And then it's just, a lot of times trying to get out of that cycle. So offering maybe a 15, 16-month lease to at least be in February of the following year. It's always hard because it's sort of a balancing act where you're already going to take a lower rent than what you wanted. So to lock that in over a longer period of time isn't ideal. But yeah, if you try to offer like a 6-month lease thinking you'll bump the rents again in 6 months, that's harder. You thin out the tenant base that's interested in only signing a 6-month lease.
Yeah, that makes sense. I mean, we talked about that on the past, and yeah, it's hard to lock in that longer term, lower rate, but you gotta get off the cycle. You gotta get off the treadmill. Like you have to kind of bite the bullet and get off the treadmill. Because I see so many people like, why do you keep having to fall over all the time? Like, change it. So Troy, I want to move over to you. I think a little commentary and explaining of what the heck's going on with mortgage rates.
Yes.
The Fed just lowered rates, or the Fed rate a quarter point last week. Election results are in, and mortgage rates just kind of seem to keep climbing.
Yeah. So, just to give a little overview, from about a month ago, we're probably about 0.5% higher. So rates are probably on a 30-year fixed, just kind of a middle of the road, about 6.8 on average. That's the posted Freddie Mac average rate that they're seeing across the country. From where it was about a month ago, this time was about 6.3. So we've seen a half jump. And so it seems kind of peculiar that, hey, the Fed is cutting. They've cut a half to start off with. They cut another quarter last week, like you mentioned, Chris. And yet we're still seeing these rates go up. And a big driver of that, I had a good conversation with the head of our secondary department. So the guy that does all the trading with all of our loans that we originate within the company, trades them with different outlets, Wall Street for sure deals with all that. And I'm like, hey, Mark, what's kind of the scoop here? What's a good way to look at this and explain it? And he was pretty quick and pretty easy. So mortgage-backed securities obviously hate inflation. So 10-year treasuries, mortgage-backed securities hate inflation. They feel like inflation is pressing on us. You're going to see a rise in interest rates. You're going to see the 10-year treasury go up. You're going to see the mortgage-backed securities increase. And so what happened with that first cut is some of the data that came up after that half cut wasn't looking so good, more inflationary. So the feeling and the sentiment was that some of the future cuts that were being baked into the cake were not going to happen. And that the Fed may not be as aggressive. So that's why we saw a pretty steady climb up. So until they feel like inflation's under control and there's some balance, we could see some more rising. But I think generally speaking, I think the overall vibe is that hopefully things will settle a little bit. They're not as bad as what they were. I mean, we've seen a lot worse, right, Jeff? I mean, there was some stuff up in the sevens pretty solid. We were even touching into the eights. So from a very general standpoint, it's not as good as what it was for a little period of time there, but still not bad in the context of things. I think you just need to get used to a little bit more of a new normal. And like Jeff and I have talked many a times and worked with a lot of clients, just getting, building a deal or kind of making a deal happen within the transaction. We'll talk about one of the deals we recently closed on a duplex, was bought for $655,000, and I think it has some good numbers. Jeff negotiated an awesome deal for that, and we'll talk a little bit more about that. But to make it work in this environment, make it work to build a deal basically out of a property, even with the rates being where they're at.
Yeah, actually, I like it when rates are higher, Troy and Chris, Brandon. And here's why: is like competition, right? But Chris, you guys all remember 2020, 2022 is when rates are that low. Well, that was extremely low. But if rates get below a certain threshold, and I'm sure, Troy, they have a certain number where like, oh yeah, we'll have increased demand if it hits like below 5.99 or 5.5 or something. I'm sure it's somewhere around there. But when rates are high, it eliminates a lot of the competition for majority of buyers. And if buyers have all this competition, then they can't compete to buy like a first-time home buyer. So I like it when rates are higher in the sense of it's harder to qualify, but if you can almost make a deal, create a deal, because your competition for that same deal is sit on the sidelines while it's just you competing against yourself. And then sellers you just have to find a seller that has to sell. Like the seller that has to sell, and then you negotiate with that seller, and that's how you can get, instead of being stuck with that 6.8 rate, you could get that thing, buy it down, 2-1 buy. There's ways to make the deal work. And when you're in a competitive environment like COVID years, yeah, of course everyone wants a 3%, 4% rate, but that also brings $50,000 to $100,000 over asking prices, waiving inspection, waiving appraisals. It's like most buyers can't compete with that. And it's kind of, slower markets, it's a buyer's market. And that's where we haven't had this, Chris, since, I don't remember last time when buyers actually had negotiation power like this. And that's where the more negotiation power you have, the better deal you can make the deal out of it.
Yeah.
In addition, you're making a great point, Jeff, when I highlight just your attitude, the mindset, because it's like, hey, when this happens, here's a macro event I have zero control over. Here's the type of opportunity it creates. And that's always always the right investor mindset. I think it's always good to highlight, especially, the last 2 years have been very tough in real estate. We've been in a winter, so to speak, in real estate. But that's always right attitude. Hey, when this happens, here's the opportunity, or where's the opportunity is the right mindset. So yeah, I like your attitude, Jeff. So what's a year from now? What's going to be the rate? What's the forecast? I don't know, Troy, are you allowed to forecast or say Freddie Mac thinks this? Like, where's the rate in Q4 next year?
Oh boy, you know,
We got him on recording, Chris.
I know.
Yeah, no, we're not recording this, right?
Of course not.
You know, I guess my sentiment is still that we should see a little bit better. It just depends on how, you know, if the economy's chugging along. I mean, we saw the stock market do really well here post election. You know, if the economy starts to move along, we should see a little bit better interest rates, I would say, because that should be somewhat deflationary, which, you know, I don't think we'll see a recession like they had been talking. And, you know, I think we'll be better off than what we are right now would be my guess. But I'll let you, Chris, you and Jeff can kind of, let's see you guys kind of hash it out a little bit. We'll be better. A year from now, we'll be better than the 6.8. I'll put something on that.
Jeff, what's your thought?
Okay, I'm gonna go. So Troy, I look at the spread between the 10-year Treasury bond rate and the 30-year fixed rate. Right now, it's like what, 3-ish around there, or over 2, and historically it's 1 to 2. So, and I think that's because of the uncertainty and higher inflation and other factors. But okay, I'm gonna go on record. I'm gonna say this time, 1 year from now, 2025, I'm gonna go 30-year fixed rate, owner occupied. You know, good credit score, all that fun stuff. 6.5.
I could back that up. What do you think, Chris?
I want to ask Brandon. Brandon, you got any thoughts?
Yeah. I mean, the only thing I had kind of read about that I thought was interesting, at least, was that with some of the tariffs, it may push like building materials and that kind of thing up. And so maybe we're still dealing with a little bit of inflation. I'm going to say 6.8, right where it's at today.
Yeah, I kind of agree with all you guys. I think it'll be a little bit better. I think it will be better than it is right now, but not by much. I think mid 6s or so would be my expectation. I think it's that what some people are saying, hey, rates going to be higher longer. And it's going to be, you know, slowly coming down, but they're going to stay high for a while. Relatively high from what we've seen. You can go look at 30-year data and we're still kind of around the average right now.
Yeah, we are.
All right, so there are predictions. We'll come check on that in a year. And I think, Jeff, we were betting a bottle of tequila. Is that what it was?
Yes.
All right. I love it. So one of the things I had on the docket for today was to talk about Colorado Springs vacancy and actually just kind of talk some like longer term, you know, strategic growth for Springs and Denver. Well, since Jenny's not here, it does not make sense to have that debate when she's not here. But on the last month's episode, she had shared a news article that said Colorado Springs at a 34% vacancy rate, which just seemed very, very high. So I had a friend pull some CoStar data, and I want to share the snippet, then we'll revisit this when Jenny's back. A wave of construction deliveries provided tenants with plenty of options in the market. In the past year, vacancies are at 13.8%. Up from 5% in mid 2021. So they're saying about a 14% vacancy around the 32%. So somewhere in the double digit range is my guess. And rents are down negative 1.1% a year. Now this is for, you know, multifamily downtown Colorado Springs. However, new construction starts have plummeted. The downshift indicates that apartment should find relief from the supply side pressure in 2025. CoStar forecast demand being outpacing new supply beginning in Q4 of next year. So resulting in steadily declining vacancy and, you know, rent growth. So we'll have fun talking about that, but I don't think vacancy is quite at 34%. So next time we'll go into more details. But I wanted to share that stat because I know we had a few people talking about that market. All right, let's talk about some deals. Jeff, Troy, I know you had a house hacking deal highlighting someone that moved out of state from a higher cost of living of area, and you guys put together like a great winning deal.
Yeah. Go ahead, Jeff. You kind of lead in and I'll throw in on it.
So side-by-side duplex in Arvada. Just, you know, 1960s brick construction, new roof. New windows, just kind of like mostly cosmetic paint, flooring, baseboards, countertops, like nothing fancy. No frills, duplex, but side by side. And really close, about half mile from Old Town, Nevada. And, you know, it was on the market a little bit. And what I like when stuff sits on the market is I look at it as, you know, room to negotiate. You know, you could throw in a disrespectful offer and use your buyer's leverage where they have it for now. And there was no competing offers. We threw an offer, and 655, Troy, right, was the price.
Yeah, 655 was the purchase price.
15K seller credit on the front end. We were pretty confident that based on the comps that we could support that price and it would appraise. And then through negotiations, we got the seller credit up to 18K.
Yep,
After
18,000
inspection, and I believe he used it to buy down the rate, pay off closing costs. Troy, is that correct? And then
Yeah.
what is
Yeah.
that? What was his final like mortgage payment with that rate and all that on that guy?
So all in payment. So obviously 5% down. Bought down the interest rate to 6% on a 30-year fix. That was pretty stellar. Covered most of the closing cost. So his all-in cash was under 35,000 to buy it after your great concession you built in for him, Jeff, on the contract, which really covered everything, bought down that interest rate. We kind of caught that rate at a good time as well. And then as a first-time home buyer, there's some additional perks they were able to apply to kind of get that rate down more for him. But yeah, he was comfortably under $4,500 all in on the payment. And then I think 3-bed, 1-bath. The property was vacant, so he could choose which unit he wanted.
Both sides are vacant. That's another nice thing, Chris, is and Brandon, is usually these multis, unfortunately, I've inherited tenants, which I'm sure, Brandon, you don't know all about when you're taking over a property sometimes. And this one was vacant, so it's perfect for a house hacker. He can move into one side and rent out the other. And the strategy he wanted to employ, just based on location, condition, and maximizing his rent, was the Section 8 strategy over there, and he would get about $28.74 with the 3-bedroom voucher in that part of town in Florida. And then he would take one side. And what's interesting too, and Troy knows this, is he's coming from Seattle, from a 2-bedroom over there, paying about $2,600, and now he's going to get a 3-bedroom over in Arata. And after, with the tenant on the other side, you know, he's not going to be living for free, but it'll be about $1,600 a month for his own 3-bedroom unit in a part of town he wants to live in. And he gets to build equity, and then a year from now, when he does move out of it, he'll cash flow. But it's a great first one to start with.
Oh, that's a great win for him. Yeah, I mean, great part of town they wants to live in. Paying less in rent than he was, plus he's building equity. Win. So great job. Well, Brandon, I know you had said, talking about deals, that you had looked at some of the recently onboarded properties you had and could share some high level numbers. What can you share from some recent like onboarded properties?
Yeah. So one that I was looking at, it's a client that already had some properties with us. So an experienced investor. He bought a condo in Wash Park, kind of a garden level in like a 5-story, 6-story building. 2-bed, 2-bath, about 850 square feet. Paid $299 for it. It's not really fixed up. It's kind of dated. Interior, it looks clean, but so yeah, rent on that. We've got it listed right now for $1,900. So yeah, not a home run, but something that I don't know what his financing strategy and all that is on it, but yeah. And like I said, the 2 bedrooms are a little tough right now. So it's been like 10 days active or something, no interest yet, but yeah.
All right. Well, we'll have to keep up to date as to when that gets rented, but what you guys are in the slow season now.
Yeah. And sometimes I think people are willing to they'll get a better deal on the buy side, more negotiating power, that kind of thing. So, you know, they understand it'll be a little under, you know, the rent will be lower for the first lease or whatever, but get it back to performing better in a year or whatever.
Well, that's what we talked about. I mean, like there's go out there, get some really good deals, especially in like Q4, you know, end of the year now. There are some good deals to be had in terms of like a strategic long-term play. Get it operate it and they get on the right cycle and they can be strong, strong properties. And I've talked to 2 different flippers over the last year who had different flips, condo flips going on, and they both had a hard time selling them anywhere near the price they wanted to. And so I imagine there's opportunities to go there and, hey, pick up a good property and, a little bit of a discount and move on.
We get inundated this time of year with calls from people who can't sell, and their first go-to is always like, we're thinking we want to just lease it for 6 months and then put it back on the market, which I don't think is a great strategy. And that's a lot of work and wear and tear on the property, and to have a move in and move out,
not worth it.
It's not worth it. Yeah. So that's a conversation we have a lot this time of year of like, you got to decide, either lower the price or, let it sit vacant for a while, try again in a couple months. But
so
it's not.
If you have 10 of those calls coming in, what percent end up like renting out for, 12 to 18 months plus and actually turning into a rental? Is that
probably 2 or 3 of them?
Wow. Okay. So you get 20.
Yeah. Some of them certainly. And sometimes they're like a little more like, I could hold it as a rental too. I'm not opposed to it. And if it goes well, they'll stick with it and that kind of thing. But
yeah. Okay. So out of 10, about 2 or 3 are, that's a really interesting data. All right. Well, we are coming up here towards the end of the show. So we will, we'll wrap up. I know we will save for next month. I think we can make a little more of a predictions one too, or getting year end. We'll talk about Colorado Springs and then lots of stuff to, predict and see where real estate may go with the new administration, and not talking about, politics, but talking about policies, like how do the policies they may pass, how does that impact real estate investing? We will talk about that next month. So Jeff, Troy, thank you guys. Brandon, awesome job. Glad to have you on the show. So thank you. And then we're out there. We'll see you next month. Bye, everyone.
Yeah.